Well, welcome to Chapter 7. Chapter 7 is about consumer loans. We'll talk about what that means here. So you can see what the learning goals are right here. We'll go through all of these. You can see the part about how will this affect you. It's important to understand when you use credit to be able to calculate and compare the cost of that credit and determine the circumstances where it makes more sense to take out a loan versus paying cash. It's a lot about what we'll learn for this chapter. I'll let everybody look at the financial facts and fantasies on their own. Okay, consumer loans. The ability to borrow does not mean that you need to borrow funds, right? Just because you can borrow doesn't mean you necessarily should borrow. Purchases should only be made when you have the budget for the purchase, and the item purchased should have a useful life longer than the term of the loan used to purchase the item itself. So a consumer loan is a loan made for a specific purpose using formally negotiated contract that specifies the borrowing terms and what the repayment terms are. It's a one-shot transaction made for a specific purpose. No more credit is available, no credit card or checks, or used to borrow money to pay for big ticket items. So some examples would be auto loans, which we talked a little bit about in previous chapters. Durable goods such as furniture, education loans, personal loans, consolidation loans. So, basically, if you are looking to remodel your home and you could maybe do some kind of a loan for that. I know a lot of companies that will do remodeling will offer some financing also. That's kind of one option we're talking about. So it's basically something that's going to be more expensive. But you don't want to put the money down. Maybe you go out and you borrow part of what that is, whatever the purpose is. But these are the good examples of what consumer loans are. Or student loans. I'm guessing a lot of you are aware of student loans. The Stafford loans, direct and federally federal family education loans, Perkins loans, and parent loans, what they call PLUS loans. So. These are all federally sponsored student loans that many of you are probably using to some degree to help pay for your tuition at USF. So Exhibit 7.1 from the chapter talks about what some of those student loan types are and what the interest rates are and so on, kind of just what the limits are, the fees and so on, what the terms of the loan are. So I'm guessing a lot of you are doing some things like this already. With most consumer loans, the characteristics of these loans is there's a single payment and a specified period and a lump sum payment when it's due. Potentially a installment where you're making a fixed scheduled series of payments. Fixed interest rate, usually that's the case with these, is the interest rate is the same. Or a variable rate where the interest rate may change periodically. So single payment or fixed payment, then fixed rate or variable rate. Sources of these types of loans: commercial banks, loans to consumers with good credit. Consumer finance companies typically offer a little bit higher rate, but they're easier to get. A credit union, savings and loans, sales finance companies, life insurance companies, and friends or relatives. It says down here, not advisable for friends and relatives, just an FYI. Features of commercial loans, of course, there's the finance charge, the loan to maturity, the cost of the transaction, the collateral, payment date, prepayment penalties, and late fees. So just things that as you go about applying for one of these loans, these are just things that you will see that you will need to consider paying for, or just terms that will come up as you go through the process of applying for and becoming approved for these loans. So keep track of your credit. Worksheet 7.1. One of the there's two Cengage problems for this chapter, for chapter 7, and one of them will use worksheet 1, which is just simply an inventory of debt. And so this worksheet shows you what the different types of debt you may have are. It's organized by types of debt, who the creditor is, what the payment per month is, and then what the latest balance due is, just to help give you a handle on all of your payments that you have to make. So it's always good to have a handle on the types of payments and loans that you have outstanding. So it's just a good worksheet to help you do all that. We just keep inventory of your debt. And then, of course, it checks your debt safety ratio, which should be less than 20%. So ideally, that is less than 20%, which is your monthly payments divided by your take-home pay. That computes your debt safety ratio. Single payment loans, again, it's a lump sum that's due. Loan collateral could be a lien, a mortgage collateral note, loan maturity, loan prepayment. Potentially with these, there might be a prepayment penalty, just an FYI. Finance charges and the APR. The APR stands for annual percentage rate. The simple interest method is calculated on the outstanding balance. Interest times interest equals your payment. Discount method, interest calculated on beginning principal balance and subtracted from loan amount. Remainder goes to borrower. And finance charges that are paid in advance, and the APR will be higher than stated interest rate, which is almost always the case with these types of loans. Simple interest method, interest or finance charges is the interest, P is for principal, T is the time period, loan of $10,000 for 2 years at 8%, interest for the entire term of loan with no compounding would simply be $10,000 times 8% times 2 would be $1,600, and the amount due in 2 years would be $11,600, the interest plus the $10,000. The APR, the calculation for APR is your average annual finance charge divided by the average loan balance outstanding. In this example, it says $10,000 at 8% for 2 years. You can see how it calculates what your APR is at 8%. The discount method, finance charge is computed the same as principal interest, but the finance charge is subtracted from the principal, and the net is given to the borrower. For example, $10,000 8% 2-year loan. Total finance charge is $10,000 times 8% times 2 years, which is $1,600. And amount to borrower is $10,000 minus the $1,600, which is $8,400. And then your interest rate or your APR is 9.5 based on that. So you get $8,400, but you have to pay back $10,000. Installment loans repay debt in a series of equal payments. Payments include both principal and interest. Wide maturity ranges of these, 6 years, 10 years, or even longer. Calculating interest on these, you've got the simple interest method. Interest is just simply calculated based on what your outstanding balance is each period. Or the add-on method, where a finance charge is calculated on original loan balance and added to principal. So some examples of these, calculating finance charge on installment loans, calculate the finance charges and APR on a $10,000 loan to be repaid 24 months installments at an annual rate of 8%, using Exhibit 7.6 from your book. For 8%, 24 months, $1,000 loan, a factor of 45.23 is made for a $10,000 payment is 10 times 45.23, which is $452.30 for your payment. You can use Excel, you can use the PMT formula in Excel to come up with the same thing, or you could use your financial calculator. So there's 3 ways to compute this. Factors from the present value, future value tables in the back of the book, Excel, or a financial calculator. Calculating finance charges on installment loans, then we established that one payment is $452.27. Interest is 8% divided by 12 months, which is the 0.6667 times the $10,000 principal loan due. Interest is $66.67, so that first payment of $452.27, $66.67 is principal, and the rest is interest. And so the way these work is you pay a lot of interest. That payment's the same for every payment, but the split between principal and interest within that payment changes with every payment. And the earlier payments is more interest than principal, and the later payments would be more principal than interest. The simple interest method is simple interest is calculated on the outstanding balance of each period. Each payment decreases the outstanding loan balance. Subsequent payment incurs a lower finance charge. More of next payment goes towards repaying principal. Using this example, total payments over 24 months. which would be 452.27. This is a 2-year loan, so it's 24 payments. You get 10,854. Loan amount is 10,000. Interest would be 854.48. And so with the add-on method, then calculated finance charges on the original amount for the full term. 10,000 times 8% times 2 years is 1,600. We add that on to the $10,000 for 11,600. Divide that by 24 payments, and each payment then is 483.33. So there's lots of ways to do that. The bank or the lending institution has to disclose to you what the methods are, so that you know that. They have to tell you that. You have to sign documents saying that you understand how this is all being calculated. So they're never trying to hide that from you. They have to tell you. And then using your APR, or computing the APR, I should say. Of course, APR will be different based on these various methods. So your average annual finance charge divided by the average loan balance outstanding gives you your APR. You can use a financial calculator to compute these also. And so they're computing finance charges based on if it's simple interest or add-on interest, the stated rate of the loan, the finance charges, the monthly charges, the total payments, and what the APR turns out to be if it's using simple interest or the add-on interest methods. Just some other considerations for consumer loans: prepayment penalties, credit life insurance. Generally, some of these do offer prepayment penalties. If you can avoid those, please do if you can. But do best not to have those. And it's never, to me, it's never right that if you offer to repay your loan early that you should be charged for that. Credit life insurance rarely is a good deal. It's basically insurance if you die that will then cover your principal due. It's rarely a good idea. It's very expensive. Typically, I would not use that. Rule of 78 is called sum of the digits, a method of calculating interest that has extra heavy interest charges in the early months of the loan. Credit life insurance, I already mentioned that one. Buy on time or pay cash. Do not deplete emergency fund. And then consider using worksheet 7.2, which I have open, and you'll be using this one for your second Cengage problem for Chapter 7. And you can just see it says, should I buy on time or pay cash? And so this kind of gives you some information here to help you figure that out. Do you buy on time or pay cash? So it'll just walk you through the steps to do that, and you'll be doing one of these to help you do Cengage for Chapter 7.